everyone, and welcome to Lesson 33, Accounting Procedures for a Merchandising Business. So far, you have learned the following facts about the periodic inventory system for a merchandising business. 1, the final inventory figure must be included on the balance sheet as a current asset. 2, the cost of goods sold figure must be included on the income statement. 3, neither the inventory figure nor the cost of goods sold figure is known during the accounting period. And 4, the cost of goods sold figure can be calculated by means of the formula developed earlier. So now, with this in mind, you will learn about the accounts that are needed to do the accounting for the cost of goods sold and the merchandising inventory. The merchandise inventory account of a business is kept in 2 accounts. One account is called the merchandise inventory account. All the adjustments to inventory are put into this account, and the purchases account. The purchases account has the amount of merchandise purchased for resale during the fiscal period. In other words, purchases is the other account where the merchandise inventory of a business is kept. The merchandise purchased during the fiscal period is collected in the purchases account. Purchases is a short version of purchases of merchandise for resale. The purchases account is found in the expense section of the ledger. Some accountants place it as the first account in that section. If merchandise for resale is purchased for cash, the accounting entry at the cost price is as follows. So we have our purchases debited. So in this example, for $500, we have our HST recoverable, which is calculated at 13% for $65. And with this, we are going to credit our bank for $565. If merchandise is sold for cash, this will be the following entry. So for example, we have bank for $113. Then we would credit our HST payable because we have to pay that tax. Again, this is calculated at 13%, so it would be $13, and our sales would then be $100. So our bank total would be the 2 credit accounts added up, so 13 plus 100. If we are looking at merchandise purchased for resale on account, this is the journal entry that we would have. We would have purchases debited for $200. We would have HST recoverable for $26. Again, we're calculating in this case at 13%, and we would credit accounts payable. Make sure that you understand that it is the purchase of merchandise inventory that is being discussed in these examples. Other items purchased are handled in the usual way. For example, let's say a tire company buys office supplies. Office supplies is debited. However, if a tire company buys tires for sale to its customers, so if they're selling those offer resale, then we have purchases debited. Okay, so make sure you are looking at what the transaction entails and if it is a purchase for the company or for the company to resell. In this example, let's look at what would happen if there were $100 worth of merchandise sold on account. So we have accounts receivable for $113. Our HST payable would be credited for $13, and our sales would be credited for $100. Remember that when a business sells goods, the physical inventory is reduced. However, no accounting entries are made to record this decrease in inventory when the periodic system is used. It is easier to allow the inventory to be inexact during the fiscal period and to correct it at the end with adjustments. And you will see this later on in the unit. All right, now let's look at the freight in account. So the freight cost is considered to be one of the costs of the goods. The freight in account is used to add up any transportation costs on incoming merchandise. This freight in cost is included in the calculation of the cost of goods sold. Okay, when we look at the freight in account, this is the cost of shipping goods into the store for sale to customers. And the delivery expense account is when you're looking at the expense of shipping out goods that have been sold. So that it can also be referred to as freight out. And duties, this refers to the special charges imposed by the government on goods imported from another country. So let's say you were importing goods into Canada. You are required by law to pay federal and regional sales tax on the goods. The Canada Customs duty rates are regulated by the Canada Customs Act and enforced by the Canada Border Services Agency, or in other words, CBSA. Okay, so now that we know about freight in, we have a new cost of goods sold formula. Okay, so our new formula entails the beginning inventory. So we take that beginning inventory, we add, and in brackets, our purchases plus our freight in. Then we subtract our ending inventory, and that will give us our cost of goods sold. Other formulas to know, sales minus gross profit also gives us cost of goods sold. Our gross profit minus our expenses equals our net income. Okay, this is an example of the income statement. So our revenue is the same. We have our inventory. Now we are seeing our purchases. So in this case, 3,000, and our freight in. And then we have our cost of goods available for sale. Okay, so that is found by taking our beginning inventory, adding our purchases, adding our freight in. So in this case, it's 70,000. Then we subtract our ending inventory. So our ending inventory from, in this case, is December 31st. So that's the end of our fiscal period. In this case, it's 45,000. So 70 minus 45,000 equals our cost of goods sold of 25,000. Now, to find our gross profit, we take our sales, our revenue, and we subtract our cost of goods sold to get us a total of $75,000. Okay, so these are some other formulas that you would need to know. Okay, and it's a different way to rearrange the formulas as well. Okay, so when looking at the income statement, remember this order, this format, and what numbers we add together and what numbers we have to subtract.